Well, I'm back for another forest walk with you guys today, and I have my lovely wife Lizzie with me once again.
Hey guys!
She'll be joining me, and t-shirt and no sunglasses today. We're in the woods, so we don't really need it. Lots of shade in here. But I figured this is a good spot to talk about how the U.S. economy is entering the danger zone, according to Morgan Stanley. And once again, guys, this stuff is not according to me. It's not like I'm, finding all this stuff and making up all these terms that we're in the danger zone or going into a recession or whatever. These are all things that are being reported because of the state of affairs right now. So this is something I've never actually heard of and have never reported on before. But this new warning from Morgan Stanley comes in the wake of the most recent jobs report and the most recent unemployment report. And what they're looking at is called cyclical employment. What that is it's payrolls minus government, healthcare, and education, which is totaling 78% of all employment. Because if you guys remember my video from the other day talking about the jobs that came out, most of the new jobs that were created were in government, healthcare, and education. Last month, it fell to negative 58,000. Now it's down a negative 271,000 since its May of 2023 peak, and it's declining at a quick pace, which means that there's not really that many jobs being created outside of these few industries. So there's not a lot of private sector jobs going on, and really government, healthcare, and education are all kind of wrapped into a bundle because a lot of healthcare jobs get subsidized by government spending, same thing with education. So when you combine all that together, it's like really just the government jobs and the government numbers that are propping up the look of things. And even with that going on, things aren't looking too good. And the reason why this matters, according to Morgan Stanley, is because the last three major recessions we went into, which was 1990, 2001, and 2008, the cyclical employment always turned down before the headline payrolls did. So the fact of the matter is, this is not a sign of a healthy labor market. And between the higher Fed's funds rate and the tighter bank lending standards that are happening right now, you also have revenues at risk of declining substantially for a lot of different companies, which we've seen happen recently as well. That's why you've seen so many layoffs and problems with the stock market, because these higher interest rates have brought down revenues for a lot of these companies, because these companies have relied on low interest rates for years, if not decades now. And since they haven't had low interest rates for the past couple of years, they're having to pay more in interest, which means that we can't borrow as much. And when we do borrow, we have to pay more. It means that we can't hire as many people. So these higher interest rates have been affecting companies tremendously. And another thing that this has done is it has increased the unemployment rate. So whenever the Fed has gone through a tightening cycle like we're going through right now in the past, there has always been a recession. So this is the warning that Morgan Stanley is giving us, that just looking at this data alone, it proves that we are headed into a recession right now. If not, we're already in one, like I've been saying here. Now, as I'm shooting this video, it's Tuesday, and the CPI report comes out on Wednesday. So by the time you guys see this video, it'll already be Wednesday, and we might already have the CPI information. However, one thing that a lot of economists are looking at right now is they're wondering if the CPI report that comes out on Wednesday might lead the Fed to do a 50 basis point rate cut. Because the weaker the inflation number is, then the higher chance that the Fed does a 50 basis point rate cut. And let's define what weaker inflation number is. The more inflation is coming down, then the more likely the Fed is to actually cut rates by a higher amount. The August expectations is that it's going to be down to 2.6% from the 2.9% it was in July. So that's what expectations are saying. We'll see what actually happens. So a lot of analysts are thinking that there's a high probability that once we get this inflation report, that the Fed will actually cut rates by 50 basis points here in September rather than 25 basis points. And remember what I said before, guys, if they do this, this is the Fed hitting the panic button, okay? It's a subtle way, it's a subtle panic button. It's not like, we're firing rockets at anybody, but what they're doing is they're firing rockets at the US economy in hopes to save it from this impending recession that we are already in, which is not going to work, but they will definitely try it if the data supports it. But I'm not even sure how much this new inflation report is really going to affect the Fed's decision anyhow, because Jerome Powell said not that long ago that his main focus moving forward is going to be the labor market, not inflation, because he already thinks inflation is coming down to a reasonable enough amount where they can feel good about cutting, but they're worried about the labor market, and rightfully so, based on all the horrible jobs data that we have seen recently. And one thing a lot of stock analysts are saying, that we are at risk right now because of how much the stock market has rallied and how much they're banking on future rate cuts. And of course, everybody who plays the stock market is hoping for and banking on a 50 basis point rate cut, because they believe that will be good for the stock market, because the stock market has so many rate cuts priced into today's valuation still. Even these guys are starting to recognize, like, yeah, we had, the jobs numbers looking good for the past year, but then once the downward revisions came in, that was a big miss that a lot of people weren't expecting. And so this is starting to throw everybody off and getting people to rethink, are these stocks and are these valuations really where they need to be right now? Which I think most of us know the answer to that. So right now, the current futures betting market is saying that borrowing costs will drop by 2.5% through the end of 2025 and will drop by a full percentage point before the end of this year. So we'll see, guys. Is it really going to come down by that much? Do you guys think the Fed is going to drop rates a full 1 percentage point or 100 basis points by December? I feel like that is kind of unlikely, but if they do, just remember, that's the panic button, and that is your sign and signal of the start of the official recession, okay? Once they start doing that 100 basis points rate cut before the end of the year, this is going to mark the next big recession when we look at the Fed charts going backwards into history in the future. And by the way, anybody who's wondering where I'm walking today, I'm walking right along Larksburg Creek over here in the forest, somewhere in the middle of Larksburg. And it is such a beautiful spot. It just kind of
beautiful.
Yeah, we just discovered this by accident yesterday, so cool spot. Now, there was also a recent survey done from Americans to try and figure out where people think rates are headed in the country, because it's not really a big surprise that interest rates are going to come down. We know it's going to come down, but we're just not sure how fast and by how much. That's kind of like the question mark. So right now, American consumers expect mortgage rates to fall over the next 12 months. Not really a big surprise. However, the amount of people who believe mortgage rates are going to come down has jumped. So right now, 39% of people believe that mortgage rates are going to come down in the next 12 months, which is actually the highest figure since Fannie Mae started keeping track back in 2010 of consumer sentiment. So people have never been more sure of an impending mortgage rate cut than right now. And they're correct. I mean, look, it just fell again, guys. Like, we were at 6.35% last week. Now we're sitting at like 6.25%. So it came down even further in just a week in anticipation of the upcoming rate cut. Now, here's something I find interesting about this survey data is they found out that actually don't just expect mortgage rates to go down over the next 12 months, but they also expect that home prices will fall over the next 12 months, which makes me very happy, because that means people have been listening to my videos and people's like mine that show you that every time we have Fed rate cuts like this, you also see the demand for homes go down at the same time, because people are also sitting there waiting like, well, how far are rates going to come down? I might as well wait to buy because it's going to be even cheaper if I wait. And that's exactly what's happening right now. And that's exactly what's going to continue to happen as they drop the rates. And even more interesting than that, people are expecting mortgage rates to come down and home prices to come down. And at the same time, people are sitting on the sidelines and waiting. In fact, 83% of people who answered this survey said it was a bad time to buy a home, which is up from 82% from the previous month. So people's sentiment about buying a home actually continues to get worse, even though the market conditions are so-called improving. You know, we have lots of price cuts, home values are going down in many areas, mortgages are getting a lot cheaper than they were a year ago, but yet no one cares. The home sentiment still dropping. people don't think it's a good time to buy right now. Now, the reason that the mortgage rates fell is because when we got that horrible jobs report on Friday last week of the 142,000 jobs, 30-year fixed rate went down to 6.27%, and as of Monday, it went down to 6.25%. And the reason is because the mortgage industry believes that there is going to be a big Fed rate cut due to the horrible jobs numbers. So you have more and more economists, more and more people in the industry lining up behind this idea that there's going to be a 50 basis point rate cut, not a 25 basis point rate cut. And you know something, guys? I honestly don't want to keep bringing up the same thing over and over again. Like, some people say that, oh, this is getting repetitive, or you talk about the same thing too much. But here's the reality, guys. Like, the reason I keep talking about this stuff is because I keep seeing stories about it, and I have to bring it up. Like, for example, just today, when I was planning out this video, I saw two news stories, two big headlines talking about how great everything is, okay? Check out the first one, U.S. economy outlook. All the data points to soft landing, no recession. Even though we just got a big warning from Morgan Stanley, that's exactly where we're headed based on the current data, okay? And then you got another headline right below it that says the vibe session is ending as the U.S. economy nails a soft landing, economists say. This is all in the same day as I'm planning this stuff out. I don't know who they're trying to convince at this point, or maybe they actually believe this stuff themselves. I don't really know. But the fact of the matter is, we keep seeing stories on a regular basis that are saying that everything's going to be fine, when in reality, we're seeing data actually surrounding us deteriorate, like the jobs data, like that we just saw. The unemployment data is not looking good, even though it went down slightly. You know, those things are not looking good right now. And we're seeing home prices fall, which is a good thing. This is what we want. We want home prices to fall. But that's a sign that the economy is weak. If things were going great, as good as they say, we would see prices continue to go up. One of the main reasons that they say in these stories and why everything is going to be fine, it all comes down to spending, guys. It all comes down to consumer spending. They say that because consumer spending is still coming in hot, that must mean that the economy is still running on all 8 cylinders right now. Well, we know that people have to spend money. That's never going to stop because people need to buy stuff, right? And we also know that people have to spend more money than ever right now to purchase the same basket of goods that they did a year ago, 2 years ago, 3 years ago. So if you just buy the same amount of stuff that you used to, you're not buying more stuff, you're still going to spend more money. And they say that this is the reason why things are going well right now. But this guy, Torsten Slok, I have no idea who this guy is, he says that the bottom line is the U.S. economy is not in a recession and there are no signs of a recession on the horizon. Like, I don't know how much you got paid to say that, but that sounds extremely bullish in a time where we see everything starting to fall apart right now. Here's his basis for backing up his claims. He says, because the unemployment rate went to 4.2 from 4.3%, even though we had a big miss on the jobs numbers, that's somehow a good thing. How is that a good thing? Okay, yeah, it's good less people are unemployed, but it doesn't mean less people are actually unemployed. It just means less people are making unemployment claims and not trying to get unemployment money. Another thing that he says is that wage growth still continues to outpace inflation above the pre-pandemic trend of anemic wage growth. Well, that's also not true. I've shown you guys numerous times how when you factor in inflation and raises right now, how much wages are going up, it actually is a negative number. So there's no way that those figures are keeping up with inflation, okay? The average pay raise is below the rate of inflation right now. And some people aren't getting raises at all. The wage growth accelerated to 3.8% in August, well above pre-pandemic levels. Well, they say that inflation is at 2.9%, so somehow you're supposed to be getting ahead of the game. Well, you know that inflation is actually higher than 2.9%, and when you factor in taxes, you don't get to keep the full 3.8% raise that you get. So naturally, you're not getting a 3.8% raise. And that's supposed to be a sign of a strong economy that we're not heading into a recession, according to this guy. But this one is really the kicker, and it comes down to spending like I talked about before, okay? He goes that the daily data for debit card transactions show that consumer spending has been accelerating in recent weeks. Weekly data for retail sales also went up last week and remains solid. Once again, people need to spend this money. This isn't by choice. And I'll bet you if they check the credit card transactions, it's also up as well because more people are putting this stuff on credit than ever before too. And this is the real delusional part. This is where, the wheels just come off the bus for me. He goes, relatively speaking, few people in the economy seem to be losing their jobs or getting fired. Like every single week, we're talking about major layoffs that are happening. I've covered numerous amounts of them here on the channel. We talked about the big one that happened with Intel. People with Apple are losing jobs right now. Like literally everybody is letting go of people. You're seeing a lot of people lose jobs at a time when this is supposed to be the greatest economy ever. Oh, and don't forget the corporate profits. This is another reason that the economy is strong right now, because corporate profits are so high. Well, that's just because they're letting go of so many people. All these layoffs translate into higher corporate profits. So it's kind of like trying to twist a negative into a positive, if you ask me. I'm just looking at the data for what it is. Like when you see unemployment data going up and you see the jobs numbers going down and you see, these corporate profits higher, things like that, this is not a sign that things are going well. This is all a sign to me that things are being, stitched together to only benefit the wealthy right now. And to me, perhaps the strongest signal of all that we are heading into this recession is how much everybody's putting things on pause. When it comes to investors, people looking to buy homes, everybody's just taking a wait and see approach right now, buying new cars, pretty much anything, because nobody really knows what's going to happen next, but they want to be prepared for whatever does happen next. And if you think about it, sitting and waiting for any big purchase or investment right now is probably the smart move, because there's so many things that are on the hinge of change right now. We have these big Fed rate cuts potentially right around the corner. We have the presidential election right around the corner. Those are two major milestones in this economy that people are going to have to look at and, adjust their strategies moving forward depending on what happens next. You even have investors that are basically conflicted and at odds with each other about whether or not the most recent jobs report is a good thing or a negative thing for the economy. Some of them think, well, it's just a gradual slowdown, it's things getting back to normal, or it's the start of a serious downturn, which that's what it seems like to me, because we've seen a big change in these numbers relatively quickly. And we also seen the revisions come in far higher than what anybody expected they would be. So to me, that's a sign of trouble. You have a lot of companies that are completely not hiring right now because they just want to take the wait and see approach. It's like, let's wait, let's not hire anybody, because over the next couple of months, things are going to be changing pretty dramatically here. When you look at people quitting their jobs right now, you have people quitting jobs at a 6-year low. The only time it was lower than now was during the pandemic, when people were worried about whether or not they were going to be able to get another job or not. So people are just kind of taking the wait and see approach. Let's not switch jobs. Let's not buy a house. Let's not buy a car. Let's not make any major investments. Let's wait and see what happens. I don't know, you guys tell me, let me know what you guys are doing in the comments. If you're taking a wait and see approach, if you're still investing business as usual. I still feel very confident in the direction of gold and silver. That's why I took on the gold sponsorship for this month. And I think that, that's gonna remain high, because inflation is going to remain high. Even if it comes down to where the Fed wants to see it, the inflation that we've seen has been permanent. So the rise in the value of real money, as far as I'm concerned, is here to stay. It's not really going to drop much lower than where it's at right now. I feel like that's the only thing personally I feel good about buying right now. And everything else, I'm taking a wait and see approach as well. Like, I've been looking at open houses and stuff around here. I've shown you guys examples of places selling for considerably less or even the same price than what it was a couple of years ago. So it's like, if that's already happening now and interest rates are higher and inventory is still relatively low, how is that situation going to look in a year or two from now when inventory is a lot higher, interest rates continue to come down because of all the Fed emergency rate cuts? So I think taking the wait and see approach is very smart right now. But anyways, I hope you guys enjoyed our little nature walk here through the forest. I know I certainly did. So if you enjoyed this video, make sure you are subscribed to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.